We're going to obviously go through the morning momentum. We'll talk about the runner at 9 o'clock with some ideas, talk about triple witching, different ways to trade it, and we're going to be focusing on one gold and silver trade because that is one of the key trends that are going to continue through 2026. You'll get that traded around 9:15 this morning. All right. What are we doing here? Well, as we know, it is triple witching, so this is going to be a very busy day. Is there a time today that triple witching will make a difference in the market? It'll be on an hour. It'll likely be somewhere around 11, maybe 12, maybe 1 o'clock. But we are going to be looking for some rotation and for markets to make a decision in which direction they want to be heading. I lean bullish after triple witching in December. But once again, we could see some profit taking. We could see some additional tax harvesting. We're going to position ourselves, and we're going to talk about momentum in a moment. But again, is this a good day to trade? Is this the day that we need to be involved in more intraday focus? Should we be looking out into January? How should we position ourselves? It comes down to your tolerance, but it'll be a very busy day for all of us in the member room. So if you are not a member, remember, opportunity to come in, pick your price for the first month. This is going to carry you through the end of the year. This is going to give you an opportunity to take advantage of our forecast for 2026. Click the link, get in the room, join us for the end of the year and through the first few weeks of January. And if you join us now, remember, it's going to take you from third Friday to the next third Friday, which is that January 16th period. And as I've talked about in the past, last year, huge moves in the oil markets from third Friday to third Friday. We'll talk about that positioning as we move toward the end of this broadcast. Momentum in the market. Okay. Every day you get up and you look at this screen and you go, what is all of this? This looks like some sort of bizarre 1970s vehicle. People trying to make it look very futuristic. Well, this is very simplistic. All right. All I'm doing, I'm taking every stock on the S&P 500 and I'm putting it on a bell curve. Now, if you don't remember what a bell curve is, I can't help you there. Go on Google, look it up. But a bell curve might actually just kind of look like one of these things, right? A half oval. Well, here's the key thing. We're only focusing on the number of stocks that are over here in terms of performance and way over here in terms of performance. We're not looking at the stocks that are up 1% in the week. We're not looking at the stocks that are down 2% in the month. We're looking at the stocks that have been up consistently over a month and are up at least 5% in the last week. Okay, so there's been strength, and now there's more strength. This is called a segment 6 stock. Now, on the other side, you have stocks that are breaking down. We take the number of stocks breaking down, right? Down on the month, down 5%. This is the poor man's way of doing this. I'm not going to go through all the different coefficients of the S&P 500 and all the sectors. I'm just going to give you a cheap way to monitor inflows and outflows on the extremes. And right now, the number of stocks on the extremes, more stocks that are breaking down than there are breaking out. Down 5% of the week, down on the month, beta 1 to 2. Very important that we keep that in mind. So we're seeing weakness persist in the S&P 500. And when it moves over to that level, into the negative, we look at the Charlie FNGD. And the FNGD is an inverse ETN that is directly linked to leverage in the Magnificent Seven stocks. Why does that matter? Because when this breaks out, there is tension in the financial system. When it is above that 50-day moving average, we have seen some very bad things happen in the S&P 500. The higher that this moves, well, the worse the performance is for the SPY. And as we saw back in April, that's that big downturn. The FNGD, the way that it operated back in August of last year as well, during a big sell-off tied to the Bank of Japan, huge move up, lots of volatility. S&P 500 took a nosedive, and the NASDAQ had its worst performance. The Nikkei had its worst daily performance since 1987. So when this is elevated and this is negative, we are on alert. We have to be cautious in this environment. And yes, our SPY reading overall, based on all the different coefficients, is still positive. But the key thing to keep in mind is that the Russell reading went negative last Friday, late Thursday, early Friday. We continue to see that negative performance. The NASDAQ is being held up largely by a handful of stocks in the tech space. So we have to be cautious into today. We have to be cautious heading into next week, simply because when these figures are where they are, this has been the onset of bad events that have transpired in the financial markets dating back through at least COVID, but I can really make the case back to 1987. So we're going to be a little cautious today. We're going to look for different ways to trade. We're going to focus on the individual sectors that are positive, like the material space, and we'll go from there. The key news today, and this is, this is monumental, but it doesn't feel significant right now. It doesn't feel significant right now. But I'm going to tell you right now, it is the single most important story in the financial world. It's not even close. It's this story and then about 750 miles of dirt, and then maybe we talk about Salesforce earnings and Micron earnings. The Bank of Japan has tightened its policy. It has raised interest rates to the highest level in 30 years. Why does that matter? Because we have been engaging in what is known as the carry trade for a very long time. Cheap money in Japan, people borrow there, they come to the United States, they buy equities. If the stock market averages 9% a year, 10% a year, the 1%, the 0.5%, whatever they borrowed in Japan, they get to pocket the 9% that they made here and pay back that cheap capital that they borrowed in the previous year. This is being impacted because every single time that interest rates rise over there, it marginally impacts that carry trade. And this is why the market did this last year. That spike, that very short-term decision that the Bank of Japan was thinking about making some moves was enough to cause the biggest downturn in a very long time for Japan. Okay? The reason that this matters, and I'm not asking you to become a monetary policy expert in 5 minutes, but this is my wheelhouse. The global financial system is based on money flowing across borders, what are known as funding markets, what are known as shared credit lines. Money doesn't stay in one country because policy is local. Policy happens. One policy change by one central bank impacts money flowing across the world. And it's important because the Bank of Japan and the nation of Japan has been a supplier of cheap capital for 30 years, right? This is important. And as that rate goes up and U.S. rates go down, the impact hits everything. Dollar funding markets are sensitive to policy changes. The Bank for International Settlements, which is the central bank of all central banks, came out in April and basically said if the United States Federal Reserve makes a policy change, it impacts everybody. The same thing happens in Japan. When the Bank of Japan makes changes, it can impact the U.S. markets very quickly. It is the idea known as quote-unquote interconnectedness. Now, why does this matter? I'm going to give you a very simple understanding. For 30 years, you have lived in a house, and you've walked up to your thermostat, and you have changed the temperature on your thermostat. And your thermostat controls the temperature of your house. Very simple. But one day, you wake up, and you notice that your thermostat is not changing when you change the numbers. And you go across the street, and you say to your neighbor, hey, my thermostat's not working. Is your thermostat working? And you look at it and you see that the temperature that they have on their thermostat is the exact same in your house. It's their thermostat that's impacting your house. That's what's happening. So we're not talking about Japan. There's a lot of focus on this. Everybody's become an expert on it in the last month and a half. I get it. But the reality is this story is not over. And why does it matter? Because recently, the Fed's recent spike in repo injections was not random. A couple of things have happened all at the same time. Japan's emphasis here in terms of them having to address their inflation. JP Morgan withdrew more money from the U.S. reserves and put it into treasuries. More money they pulled out of our banking sector than all other banks put into the banking sector, creating stress. And then obviously what's happening here in terms of the United States trying their best to ensure that our banking system is shored up heading into tax season. The reason all of this matters, the reason that it's so critical, is that global banking systems are interconnected, and one change in one place will impact the changes in others. And when we made rate hike changes back in 2022, we impacted England very badly, and they had a financial crisis. If the Bank of Japan leads to more money leaving the United States, that can impact our equity prices. It can impact our valuations. It will do that. It'll impact passive investment flows. It'll impact hedge funds. It's not over yet. In fact, because of this story and because of the way that the markets have been operating, we've seen very significant spikes in volatility. And then with declines in that volatility, when these banks step in and provide monetary support, or at least forward guidance trying to provide assurance to the markets. The U.S. dollar and the JPY, we have to keep a close eye on this, watching Japanese bonds, watching U.S. treasuries, and just seeing how this impacts funding. If money goes home to Japan, money might leave and go to other nations too. People might pull money back into Europe. People might pull money into South America. We don't know, but it's something to always keep in mind and keep a focus on. I'm going to plow through this other stuff real quick, but CPI printed year over year. Not a lot of people believing this number, so there could be a recalibration in our data set coming up soon. A lot of people complaining about this. Today will be about confirmation, not celebration. We had a nice day yesterday with that focus and that emphasis on the decline in the overall inflation numbers. The bonds are going to have to validate that equity move. So rates drifting up would kill a rally. Watch the TLT, watch the TNX, watch TIP, SPX, NDX, and the DXY. Watch all of these things. And the reason that we have to keep an eye on all of this stuff is just to see what's happening with the dollar. Are there inflows or outflows? The dollar has strengthened a little bit today. Is this going to be, with all of the chatter around Japan, that rate hike finally came, and the dollar had been weakening for weeks and weeks and weeks? Could this actually be the contrarian point where the dollar goes the other way and starts to strengthen and then negatively impacts the equity markets as a result? AIs and semis and liquidity transmission test. This is not the design that I was looking for, but thank you very much, Google Slides. Semis are trying to stabilize after volatility. Micron had a great day yesterday. Oracle strength, focusing on that infrastructure. All of these names are in play, and we're going to talk about volume-weighted average price. We want to be prepared for today because it is triple witching, because we have the simultaneous expiration of futures and options and stocks, everything going on. Everybody's got a major day today in terms of their options chain. So we talked about volume-weighted average price and looking for reversions. Everything is in play today. So set yourself up. We're going to talk about how to set that stuff up in about 10 minutes, but I just want you to be aware all of these names are back in focus, and there could be a lot of rocking and volatility as a result today, and we want to start to set ourselves up for the possibility of that rebound heading into the end of the year. Finally, this is very good news. Blake and I had talked about this not too long ago. The stock's down, but shockingly, right? It was a really good report. So it becomes a sell the news event. Strong Q2 earnings, raising their outlook, cutting the guidance for the freight, and confirming a spinoff later for next year. This thing really got beat up in pre-market. Now, I want to just point something out. There's a difference between the performance of the stock and the news, right? We hit these new near fresh highs. We confirm good flows and demand holding up. It kind of supports the soft landing narrative, and they beat earnings and revenue expectations, but the stock sells off. Well, what does that mean? Well, it means that people are taking profits. The purpose of the market is to sell. As we'll be digging in a little bit at about 9:10, when we look at FDX, right, what we're going to be doing today is looking for some sort of reversion if it comes. So I need to go back here, and I need to go to extended trading hour. What I'm specifically looking for, and we're going to anchor volume-weighted average price to this reaction that happened at 1607. We'll talk about that in a couple of minutes. But what we're going to be looking for is for a rebound today. And if we get that rebound, you could trade that zero-date option. If we especially get down to a sell-off level at like 271, looking for a $4, $5, $6 move. We have to set ourselves up appropriately. That's what I'm looking for. I don't think FedEx is going to stay here all day, and I'm not going to be shocked if we see some insider buying on FDX at some point in the next week, week and a half. All right. What do we got? Go through the chat real quick. Fed is not doing quantitative easing right now with asset buying. Of course not. Why would they do that? Well, what does that do to the market, Brett? What is the question? Japan? Well, once again, we are in an environment right now where we are following momentum. Momentum remains negative at the moment on the Russell, which would persist consistent weakness in the Russell, but on the S&P 500 side, crowding into those top names. So kind of trading a little bit sideways. And for a day like today, what we are specifically looking for are reversals, and for a period in time where either we see oversold on key 15 or 30-minute levels, and then we start to look for recovery. At least that's my thesis moving into next week. SNDK, what do you do? All right, SanDisk. Pulling this up. This is the runner, everybody. Thank you, Secret Agent Charlie. All right, 221. AI trade cooling, triggering Broadcom's margin wides, whatever that means. That was a week and a half ago. But the key thing that we're looking for here is this movement higher heading into next week. Now, SanDisk, improvement here on the MACD, seeing this kind of consolidate, strength, volume improving, RSI, MFI, MACD, key momentum indicators. What we're looking for is strength here on SanDisk at the 220 level. Specifically, what I would be looking to do on a trade like this is to sell spreads to the downside, right? Because right now we're coming back above this key moving average. S&P 500 momentum remaining positive for now, selling to the downside specifically under that key 50-day moving average. So you effectively sell at the 195 level, buy at the 190 level, and you're looking for around a probability of profit of about 80%. And somewhere in the 15 to 20% performance range. That's what you're looking to make out of the trade. PENN and SFD, all in focus again, PENN. And I'm going to talk about the Warner Brothers trade in a moment. Penn has been improving. This is consumer cyclical. Relatively simple way to trade this is to buy at the money, somewhere at the 14 level, and look to sell up at the 16 level. Just to give you a little bit of an understanding of how a spread like that works. Pretty simplistic. I know that some people want to bet heavy on something right now. It's not going to be in the cyclicals. It's probably going to be in the energy side, and we'll talk about that in a moment. But the key thing here is you see that improvement. It has been a while since we had a positive crossover on the 8-day moving average and the 20-day moving average. So what we're specifically looking for into, say, January is an opportunity for us to try to take advantage of movement in the event that this stock can break out. And the clean way to do that is to do so with what is known as a call spread, where you buy at the money and you sell out of the money. And if the stock moves higher, you have a very specific cap on what you can generate. If you buy the $14 call for about $1.25 and sell the $16 call in the 35 to 40 cent range, you'll end up with a spread that's somewhere around $90. That would mean that you would need to get up to about $14.90 to break even on that trade. Your probability of success is 46%, and your max return is about 129% over the next 30 days. So you would bet somewhere around $90 to potentially make 110. If the stock moves above 16, you don't get any more of that gain, but that's okay because you're targeting, you know exactly what you're aiming for ahead of time. So if this stock were to finish January 16th at, say, I don't know, how about 1550, this trade would be up 72%. But if the stock's at 15, it would be up 15%. If it somehow got to 16, it would be 130%. That's just kind of the way that this operates. And then you set a tight stop back here at that 20-day moving average, which is 1440. And the most you can lose in the next week is about 14%. And at the end of this trade, if you held it through duration and it was still at that 1450 level, and it shouldn't get there because we should start to see some improvement, that would ultimately be about a 30 to 40% loss. So you're just keeping this short term. You're setting a stop back here, and the reason to do that is just in case the stock does pull back and this is a head fake, you have a naturally protected stop in place at the 1440 level. SFD's on this list, but I want to turn to WMG real quick. This stock keeps popping up. It has seen some strength. We're starting to see that momentum flow. I like the stock if it gets above that 50-day EMA of 32.49. Forgive me, that's not right. The 20-day is currently at 28.70. The 50-day is 29.78. I would love to see it clear that level. Looking for this curve to come back, this 8-day above this 20. There has been ample insider buying at Warner Music Group in recent weeks. Also, just getting that upgrade yesterday from Morgan Stanley to $37. Had a big day yesterday. It popped up on that insider buying level, and it is just another sign that when insiders step in, particularly at stocks of this size and caliber, the company analysts that watch it will pay attention. What is it that the CEO, the CFO, the directors are seeing that the analyst is not? So all this buying came about a week after, this upgrade came about a week after the purchase of the stock. Let me pull that up real quick. Oh wow, I did it in one try. Look at me go. WMG. There you go. Two big purchases. CFO buying 1 million in shares, 28.12, and 27.88 from a director as well. That is a big purchase by a CFO. $1 million of their own money that they put down. They filed what is known as a Form 4 document. So they're literally taking money out of their bank account and buying their stock. This is not an award. This is not a gift. This is a $1 million bet on their stock that it is undervalued. So they bought it back. He bought it back where? 28.12. So right here, it's broken out. And I like the upside here. Now, on the other point about this is that if you don't want to chase it, you could try to find a way to sell a spread under where the CFO bought it. Because if the CFO liked it at 28.12, you should like it at 27.50. Downside stocks, HPE, JetBlue, AESI. I'm going to focus on JetBlue real quick just simply because I will not fly JetBlue. Looking for some continued weakness here if we break under that 20-day EMA. Downside is back to 4. I don't know who is flying JetBlue at this moment. But same thing, stay in the money, buying the 5. If you buy at the 5, a $5 put to go to the downside, that is much cleaner than trying to speculate around, say, a 450. The reason is higher probability of profit, higher delta. You're not trying to speculate. You're not making a wild bet. You're just simply looking to follow trend, and it allows you to have a naturally baked-in stop just in case the stock does pull back. So looking at a put on something around JetBlue, well, probably out into the next month. This looks like a continuation of lower highs and lower lows. That's November. That's where the stimulus kicked in. That's our peak. That's where the Russell started to roll back over. So on a put, January 2nd, no, it's too expensive. January 16th, the $5 put is 42. 40% probability of profit, break evens under that 50-day. But I think if you can just get to the 50-day, that could be a pretty nice little gain, about a 20% to 25% gain if we can get there in the next 3 or 4 trading sessions. Other things on the runner just to pay very close attention to. Nike, not good. Again, another name that you want to be focusing on today with volume-weighted average price. We'll talk about that in a moment. Looking for a little bit of reversion, a little bit of profit take, a little bit of short covering The stock is moving toward oversold. I will just note that. When it gets to oversold, we tend to see a little bit of a squeeze. You're looking for a combination of oversold on both RSI and MFI. And when we hit that point, that's where we look for a short-term trade, particularly into the upcoming Friday, whatever the Friday is. So be a little patient with that. Also just note, watch the 30-minute chart if we get oversold on that as well. Same type of trade. We've seen this happen multiple times, particularly MFI. You get oversold, you look for a short-term squeeze. Finally, on that list, DJT. I don't want to talk about this. Do I have to? Okay, somebody front ran this. Shocker. They had a deal. TAE Technologies. Nice conference call. Stock goes up 40%. Congratulations. All right, moving on. I said that I would give you a trade. All right. Said that I would give you a trade. Well, before we get to it, pretty simplistic. I want you to just note, whether you're on TradingView or you're on Thinkorswim, we have a Thinkorswim document that we will drop in the chat in a moment for volume weighted average price. What are you looking at? Well, remember, the number one thing that I'm always looking for is the SPX. The SPX is effectively an adjusted version of the SPX, but utilizing options. They do this on TradingView. They do not do it on Thinkorswim. I'm looking for, here's your volume weighted average price. Here's your first deviation, second standard deviation, all three deviations. I'm looking for a move, an overreaction to the downside. Down here in the 4 standard deviation line. And at that point, if we get down into that level, we flip over to the SPY, and that is where we buy whatever is at the money and look for a reversion back toward that blue line. That's volume weighted average price. We use zero-date options to do that. Now, if you're interested in this and you haven't done it before, I'm going to tell you right now, you should be clicking that chart up at the top. You see there's something up here that says the NQ has a hidden structure. That is Tony's presentation from the other day. And I'm going to tell you that I went back through a lot of what he does, and I started to align this with volume weighted average price, and it does an incredible job at not just tracking down here, but also how do you make the plays at this level as well. It's a little bit more of an advanced strategy, but it's all very clear that it's in the structure of both the NASDAQ and the S&P 500. So when Tony was talking about the fact that, hey, if you're a SPY trader, you might want to look at this, the data's lining up very cleanly here, not just here. So click that link and watch that presentation, because if you are interested in following the SPY and following these bands as I am, it's pretty eye-opening that there are trades available at these ranges, and you just have to know how to navigate them and know exactly when they're coming. Great, great presentation. All right, on top of this, right, everything else is in play today. NVIDIA, if NVIDIA sells off, looking for a reversion, and I don't have to just use options. I can use things like the NVDL, right? The NVDL is a leveraged ETN, and if we sell off and we hit these key lines, I can trade 75 to 76 without having to use options. I can use the leverage of these ETFs, particularly as it is, again, a lot of action and a lot of activity today. Names like Nike, which are getting pummeled this morning, right? Going into the extended trading hour, getting beaten up. Well, what we can do is we can anchor it to the initial move after the earnings announcement, which is right here. So 16.16 is what we would anchor it to. So that is 2025, 12, 18, 16, 16. That's the first move. What could we be looking for today? Well, if we roll back here at 58.45, that's the line in the sand. That's actually the line that we could be looking for a move back toward. So keep an eye between these ranges. That is a significant range to be watching today. That is 1 minute volume weighted average price, and this is the anchored VWAP to the first move in the wake of the earnings report. It's not just Nike, of course. Remember, we had a number of other names that were in focus today. We had a big, big move that came on the back of FedEx. FedEx is getting beaten up this morning as well. We would anchor that to the 1607 level, which came yesterday. And what are we looking for? We're looking to see if FedEx wakes back up. The low of this morning is 606. That's going to put us down here. You can also anchor it to whatever the low is of this day. 290, we're probably not going to get there. The low of yesterday was at 7 o'clock post-market. And then one last thing, and then we're going to get to this trade. Come on, where are you? There we go. That is 19.7 right there. So what we're looking for when we go live, when the market opens, we're looking for a possible move down here or a move to this band and then a move back to VWAP. That's the line to watch, though. Not expecting us to break much, much higher above that level. That line just above VWAP as a possible point of any potential reversal. All right? Now, you guys are talking about a lot of different things. Do I just not give you the trade? That's okay. I don't have to. I'm going to point this out because it warrants repeating. This is HYMC. This is Hycroft Mining Corporation. This is literally gold and silver out of a ground. Eric Sprott, who I largely consider to be probably top 3 in the world at understanding gold markets, is not stopping. He is not stopping. Continuing to buy over and over again, and has been buying Hycroft from $3. It is now up at 14, and he is still buying the stock. What does this tell you? Well, it tells you that we're in the middle of a very significant change philosophically in the financial markets. This is what we wrote about last year when we wrote the Hedge of Tomorrow report. It was very clear that monetization was going to be the path forward. And it was very clear that there were shortages of actual physical metal. And right now, silver continuing to scream higher. And anyone who thinks that this is a meme stock doesn't seem to understand the underlying paradigm shift that is happening in the global financial system. HYMC has been a screaming buy for the better part of a year and a half, for 8 months, forgive me, going back to April. And it continues to burn higher. And Sprott continues to buy. This is not an effort to corner a market. This company is now debt-free. They have rolled that debt off. I don't know why that stuff's showing back up, but the continuation and the strength here is good. And the reality is, if Sprott likes this stock at $14.50, we can like it at a lot less. So let's just do something very simple. If you missed the train, what do? You go back and you look for an opportunity to trade this, trade it, and in the event that you had to buy it, you could buy it for a much lower price. This is, again, the put spread strategy. It's not that complicated. It is a very simple way to manage risk and look for an opportunity to buy something that you would want to purchase anyway. The reality of this is you can do something as simple as writing the $12 put right here. And that might get you around 40 cents, and you could buy the 11 for protection. And what does that give you? It's going to end up giving you somewhere in a range of putting up $80 to make 20 or putting up 85 to make 15. Okay? You'll get a credit. The probability of profit is around 80%. The max return on risk is 20%, and this is out a month. Your break even is somewhere around the 1180 level down here, where, by the way, Sprott has been buying multiple times since that level. Selling the 12, buying the 11, going out into January, and looking to do this trade over and over and over again all through 2026. It is 9:22. That means Don's coming up soon. It means I get to go take some back medication, which makes the next couple of hours very exciting. And I hope everybody has a very good trading day. We will be back in a little bit. I will be back at 3 o'clock for the close. Once again, volume-weighted average price. Look at the big names. Look at all of the individual sectors. Look at the XLE and Exxon, names like that. Look for a possibility of something like the XLE bouncing off the bottom today and then looking to potentially go long here. And I am bullish on energy into the rest of the year. I'm looking for an opportunity if the XLE cracks lower today, hits somewhere around that 43.50 level, 43.75. I'm going to go contrarian long into the end of the year with around the $44 or the $45 call for the final week of the year. Don's coming up. Everybody have a great day. Talk to you soon.
I step off the train, I'm walking down your street.